Right, welcome back to Charts and Trading, dear friends. In the previous video, we took time to really analyze and delve into establishing a brand new template not a brand new template, but we reordered the template of putting everything together, putting all the concepts together to establish a narrative of how we're going to be analyzing trading activity on an intraday basis. So now we're going to go directly into analyzing the financial markets. So we have a number of instruments here that we have to analyze, and we're going to see how many we can analyze in this particular video, but we're hoping to get as many perspectives. So maybe we might do half of them in one particular, but if we're able to do everything, then well and good. We may have this for the US stock market and US currency pairs, or pairs that are measured against the US dollar. And then we'll have the next video where we're going to focus more on the commodity market, where we're going to analyze different kinds of commodities, or we may analyze more stock indices from the European market and the Asian market. So this is particularly for the US stock market and currency pairs that are measured against the US dollar. So let's dive right in. Okay, so first of all, we're going to start with NASDAQ, and remember we delved into the template. First of all, we're looking at liquidity to establish the interest and price. Then we're going to volume to establish the amount and commitment of trading activity. And then after that, we're going to volatility to see the reaction, the price reaction of trading activity. And then after that reaction, we're now looking at the direction evidence of trading activity, so the direction in short. And then we're looking at equilibrium price, which is the price of interest that determines the pattern of trading continuity. So let's get right in. Okay, so I'm gonna copy this so that we see this always when we're analyzing. So this is for the NASDAQ. So now, since we're focusing on NASDAQ, right, the timing in the market is very important. So when we're establishing this, these factors work well with correct timing in the markets. As I gave it the example, and I've given this example consistently so that we can draw out of this narrative and get the best information out of this narrative. So if I am going into the market, I know you're probably getting tired of hearing this story, but follow me. If I'm selling markets to children at a particular school, I have a tuck shop there and I sell sweets. I'm not going to start selling those sweets at 5 a.m. because the children are still sleeping and they're not yet at school. I'm not even going to sell those sweets while they are in class. I'm going to target moments in time when they are available and when they want to buy and when they want to sell. So if I'm looking at the US stock market, I have to analyze the activity that is happening pre-New York, which establishes the environment. So by the time people are aware, so you still have London traders who have established a particular narrative, but getting into pre-New York, you start to get a certain narrative that is now established in the open of New York, and then you have continuation patterns or continuation trends in that move in New York session. So I hope that makes sense. So it's important that we see that. Now, we're going to first of all mark where pre-New York is. So pre-New York is here. The open of New York is here. And the open of the New York stock market starts here. Okay, so these are the charts that we now start to see. And then we're also going to mark key moments. So let's see the trading activity that happens. So this particular area will mark when London session ends. Okay, and let's go into it. So the first thing that we see is that in pre-New York, you have a certain amount of selling activity here that starts to take place. So we have selling activity that is happening at this particular price point, right? But now what happens when New York session starts, first of all, is that the sellers here, or the people who sold at this particular price point, we find that the sell side liquidity here gets swept right? It gets swept here by the buyers. So this selling price now becomes invalidated. And now, since this selling area now is invalidated, it shows that on the entry of New York, and even to go further, we see that not only are these sellers here invalidated, we also see that the sellers here are invalidated as well, because this price, okay, not yet, but we see that this price becomes weak. All right. So what we can see is that the buying here invalidated the sellers here, pushing the market up. And then when the US stock market now opens, we see a particular retracement back into that price area here. So we see a retracement. So first of all, we see a liquidity sweep, right, of this. Then what we're looking at after that is the volume, right? So the volume of trading activity here does not give us enough conviction to see that buyers are in control. So while we see a liquidity sweep happening here, this particular price area, or the buying prices here, are not strong enough to give us conviction. The buying activity, or the volume of buying activity, is not strong enough to establish that buyers are the ones who are now in control. So which means this particular price point is a price point where we're not seeing a heavy amount of interest being placed. So you see a lot of ranging here, a slight retracement. But now what happens is that there is an invalidation of sellers here by the buying that happens the moment the US stock market starts. So particularly what we like to do is that we always like to look at 30-minute chunks. So looking at what's happening every 30 minutes to see what's happening as price unfolds. There is the principle of buying and selling that happens within an hour. So we broke down that activity into 30-minute segments to see what's happening as buyers and sellers are interacting. So what we can see is that 30 minutes into the open of the US stock market, we see that there's a high level and a higher volume of buying activity that is introduced in the markets, resulting in a volatility expansion that now invalidates all this selling here. So the sellers were invalidated by the buying that happens here. So now, having established liquidity, volume, volatility, we can see that the structure shifts here, right? It shifts from a bearish to a bullish market, right? And then once that structure shift happens, so what we can see here is that after this invalidation of price and once volume enters, we can see that this price block becomes a price of interest for buying and selling activity, right? And then what we now start to see is that this price block becomes an equilibrium price, that once sellers were swept out of the market, once this liquidity sweep happened, this particular price block becomes a liquidity pool for the continuation of that particular trading activity. And that's what we see happening here, is that now traders took a position in the markets here. Let's make this a bit darker, so at least we see the price block. So this particular price block becomes an interesting area for continuation. And then we see that buying narrative continuing. And what we can see is that this generated a very good position for the people who are buying in the markets. And the particular position that was being generated was at least, let's see. So this was about, let's summarize it to about 50 points. And then what we see is that we see a 200-point move, at least a 200-point move at this particular price point. Which now gives us the narrative that this was a 1-to-4 risk to reward trade. So if you placed your capital, whatever capital was allocated for a 50-point price movement, by the means of there being a 200-point price movement means that there was 4 times the price movement from that 50-point price movement. So there was a 1 to 4 risk to reward. So if you invested $50, you're going to make $200 on that position. If you invested 100, you're going to make 400. If you invested 500, you're going to make 2,000. So that's the way that we analyze risk to reward in the markets. Okay, so we're going to go now into the S&P 500, and we see a bit more detail. And this one, what we're going to do here is that we're going to analyze this from the 1 minute time frame just to get a bit more detail. So once again, the first thing, remember our first principle is that in establishing, so we have our checklist there. We have liquidity, volume, volatility, market structure, equilibrium, price. So now having put that together, what we're now going to look into is that we're going to first of all look at the timing of the market, because timing is where all the magic happens, especially with intraday trading activity. So we're going to mark pre-New York, which is about here. My time, you can always calculate it on your charts at your time. So pre-New York is for us is here. The New York session started here. And once again, if my voice is being clouded by some rain, I hope I'm audible, but I trust that you are hearing me. Okay, so that is the open of New York. And then the opening of the US stock market starts here. So the US stock market opens up here. So what's important now again for us to see is this, is that we can see that there is a certain level of selling activity from pre-New York that started up the activity in the markets, right? So we can see selling activity happening here. So we're only gonna see a confirmation of selling activity once this particular pattern of selling activity is invalidated by a liquidity sweep. So what we're looking for first of all is a liquidity sweep to establish who is in control. So it's either going to be a liquidity sweep that validates that sellers are controlled, which means that the buyers here, the buyers at this level have to be invalidated to establish that the strength of selling activity at this particular price will be strong enough to continue the direction of that trading activity. And then we're monitoring this on a 30-minute chunk time frame to see how trading is continuing. But what we can see first of all is that the sellers here let's see, so we can see that sellers at this particular price point were invalidated as the US stock market opened. And this invalidation carries through all the way into this particular moment here. So we can see first of all that there was a liquidity sweep of these sellers, and then resulting in an overall shift of market structure that resulted from the volume of trading activity that brought about this volatility here that swept all of these sellers here. So buyers are now in control. So which means if sellers were taking a position, they would take a position at this particular price point here, because that order block now becomes the equilibrium price for the continuity of trading activity. Because what happens at those order blocks is that the market comes into a temporary equilibrium where buyers and sellers are interacting at the same time at a higher level. In other words, there is an aggressive exit of sellers at this position, or an aggressive entry of buyers at this position. So the sellers are no longer selling as aggressively at this particular price point, and buyers are now buying more aggressively at this price point, which now resulted in this particular move as well, which coincides with the Nasdaq move that we saw here, that we saw earlier, right? So we can see that now playing out. That again, we see this was about an 8-point move, an 8-point price range that resulted in about about a 40-point move. So from that we can see that there was at least a 1 to 4 on the trading activity there. So we can see a 1 to 4 opportunity both on Nasdaq and both on the S&P 500. So I hope that has given us some clarity from the point of the buyers and sellers of the US stock market. Now we're gonna end here so that we can focus in the next video particularly on the currency market. So I hope that we've seen some clarity from the US stock market and just seen how we can take positions. The beauty of the stock market is that the concept of timing is taken to a great level, and we can see that there is great activity that confirms what is taking place in the financial markets. So cheers guys, I hope we have had a fruitful session, and I hope that we've got something out of this video. See you guys in the next video.